it's Jennifer J. Hammond, and I'm so excited. As you know, I love bringing you the information that help you make good decisions in real estate. So today I'm bringing you one of my favorite mortgage brokers. And one of the things, so first of all, welcome to the show, Brian.
Thank you, Jennifer. Hi, how are you?
I'm so excited because you are so knowledgeable in this field. And so often I find people are not that knowledgeable in mortgages. And to me, knowledge really is power in deciding, especially with your money. We know, how are you going to leverage? I always say OPM, other people's money. If you're going to leverage a mortgage, you're going to leverage other people's money. So what are you going to do? So recently, I want to start with hurricanes and tragedies, because recently in Florida, we got the double whammy of 2 hurricanes last year. And so as we look forward to 2025, there are a lot of people sitting in a house and they're trying to figure out if they're going to keep the house. You know, they've ripped out the floor, maybe 3 foot of drywall is gone. And now they're just looking at this kind of empty house, trying to figure out, am I going to sell it? Am I going to try to repair it? What are some of the options with mortgages right now for those people?
Yeah, so I mean that's the big thing in our area, Tampa Bay and many other places in Florida and Georgia, the Carolinas. I mean, it's just the Helene came and it was a mess, and it was just destruction, and it's the water that really just has that mass scale devastation. And then we think, okay, let's put the pieces back together, and then Milton comes along, and here we go again. But though Milton was a more intense experience for us, with wind and stuff, it's the flooding that we avoided, and that's really the main thing that just absolutely, it just changes everyone's life instead of a few people's lives, which wind will often do. But the flooding, I'm in a neighborhood that 99% of houses completely flooded, right? No where to live. The homes, you drive down the street and it's just piles of people's lives on the side of the road, on every single street that you go down. I mean, it was a lot, right? And still to this day, people are just now trying to get to the insurance money to try to start putting it back together. So it's a lengthy process. And there are ways, though, in mortgages that you can, take a program that's designed for that specific scenario and use it as it's intended to be used, which in this scenario would be a 203H. It's called, H stands for hurricane. Very rare loan, not often used, but I did just close one today. So this is a program that we are utilizing, that we're leveraging. Now, not a lot of lenders are offering them, actually. If it's an FHA loan, and essentially the main highlights that people would want to know that they can use, if it applies to them, is if you're in a home that you were displaced from. That can be both homeowners and renters. So stopping there, it's not often that a lot of these programs apply to non-owners. Usually it's just applying to people who owned, who have a mortgage, but this applies to people who are renting in a property that was flooded as well, or otherwise. So in that scenario, if that is you, and that's way more people than it should be here, you can purchase a new home for 0% down. Usually that designation is something that, people mostly associate with a VA loan. USDA loan is another one that's technically 0% down, but much less rare because that's for rural areas. But FHA is going to let you buy wherever. If it's a primary residence, you can use it. If you were in a home that you can't live in because of what happened, you can use it, and you can buy a single unit, up to $500,000 and more, for 0% down. But what a lot of people don't know is these loans also apply to multi-unit properties. So a 2-unit, 3-unit, up to a 4-unit property, all would still qualify for this program. And that would be as high as over $1 million at 0% down, up to on a 4-unit property. So you buy it as a primary residence, you have 3 units you could rent out, live in the 4th one. Now it's an income producing property. And of course that would apply to a 3 or a 2-unit as well. Right. So, I mean, it's unfortunate why this is something that applies to our area right now, but boy, it is an incredible program, and something that people who are making one of 2 decisions, some may stay and rebuild and roll the dice again, but a lot of people are just done. They don't want to roll the dice again. They don't want to deal with that again. They want out. You can use this program to do that, not spend any money out of pocket on the down payment. And then on top of all that, that current liability, most importantly, possibly that current liability, if it's a mortgage on the property that you're moving from, or if you were renting at the property that you're moving from using this program, that does not count in the debt to income ratio. So you're qualified fully for that new property without any current liability of that property that you were displaced from counting against your qualification, your debt to income.
And so let's dig into that just a little bit for anybody who doesn't understand the whole debt to income ratio and why. So one of the things that people are familiar with is a bridge loan. So they might be thinking that they would need a bridge loan, and this would solve that, right?
Yeah, so that would not be necessary. Bridge loans, that's like one of those terms. A lot of terms in mortgages and real estate and otherwise, where I'll just get a bridge loan, but it's exceedingly rare. It is not something that is usually leveraged. It's a very uncommon scenario. A bridge loan is essentially for someone who's going to sell their home and they want to buy another home, but they haven't sold their house yet. And you're getting a loan on those proceeds that haven't occurred yet. But that loan is pricey. As you can imagine, the rate is much higher. There are a lot of limitations to it, and it's almost more trouble than it's worth often. That doesn't mean don't do it, but definitely check on the qualifications otherwise first. Essentially, if you live in the entire state of Florida and you were in a home that you can no longer habitate with normal quality of life in America, you can buy another home at 0% down with this program anywhere else in the entire state.
It's amazing. That's amazing. Because a lot of people are like you said, they're done. And maybe they're done with being like in the Tampa Bay area, St. Pete area. They're done with being on the coast. And now they'd like to move inland.
They want to get high and dry. Right.
Yeah, high and dry. They want to be on a farm instead of on the coast anymore. So 0 down is huge. And that goes to different, well, again, depending on what you qualify for, but it's a pretty big, option for people.
It's huge. It's a game changer. Absolutely. And, one of the biggest things, anyone who's looked for homes recently, right, and especially in the Tampa Bay area, it's the bang for your buck. I mean, how many people out there have looked for properties and they want to live, in St. Pete and they want to live downtown and they're just priced right out. It's just not possible, right? Our market has grown. We're still in an incredibly affordable market comparatively to other markets that have as many awesome things as we do in Tampa Bay, but still that doesn't change the fact that is a price point that's changing, the affordability for many people. And it's that if I went 45 minutes as little as often, holy cow, the bang for your buck. You went from trying to buy a place that might have been a 2-1 or a 2-2, and now you got a 4-2 and 1,000 more square feet and a brand, much newer home. And all you did was go 45 minutes in either direction, so this is a way to do that while also going into a location that you feel much safer in and hedged against the possibility of something like that happening again if you were flooded.
And so let's talk a little bit about, we talked about veterans loans, but what about an FHA loan? Talk a little bit about what is an FH loan and what are some of the advantages?
Yeah, so FHA loan is one of the main government loans that most consumers will be familiar with. They're FHA, VA, and USDA. Again, we mentioned that before. That's a rural area specific loan that does allow 0% down, always has more stringent restrictions. The debt to income ratio limitations are lower, which means you have you can't qualify for as much, basically. There's other things, right? But when it comes to FHA, a very common misconception for FHA is that it's a first-time home buyer loan. Right. That is not true. It is strictly for primary residences. That's it. If you're buying a house that you are going to live in, that's a primary residence, that qualifies as an FHA loan. The only restriction that can sometimes come into play is if your current mortgage is an FHA loan, right? There are some caveats to be able to have 2 FHA loans at once, but that's incredibly uncommon. But in this scenario, again, it still would not matter. The loan I closed today, this exact loan, the 203H, their current mortgage was an FHA loan, but because of this program, it's removed completely from being a part of the math. And they bought this home without that counting against them at all.
That's beautiful. And then what about the veterans loan? This is one of the misconceptions, a very common misconception that I've heard so often with the veterans loan is that if you've used it once in your lifetime, you can never use it again.
Well, yeah. So yeah, I hear that a lot too. Just like the FHA first-time home buyer thing, that's not true. It is absolutely not true that VA loans can only be used one at a time or one and done, right? I have many clients out there with 2, even 3 VA loans out there. It just depends on the eligibility, right? And the way that math is done is getting more and more available, so to speak, right, to people who qualify, for those types of programs every single day, because they essentially go with whatever the conforming loan limit is, right? That conforming loan limit was raised again this year to over $800,000, 800,000 and change. So that essentially means, let's say it's your first VA home, right? You could buy an $806,000 home at 0% down, period, right? And the way to very simply do the math, this is not precise, there is a specific calculation, but if you think about it, right, this is close to being accurate and an easy way for consumers to do it in their head or just do it on paper. Essentially, you bought your first house for 300 grand, right? The new conforming loan limit is over 800 grand. Very simply, you could potentially buy another house for $500,000, also at 0% down, while still retaining that previous property that you already have a VA loan on, because that's the eligibility you have. You still have that much eligibility to go, and it's based on that conforming loan limit, which every year it goes up, that just gives even more room for those borrowers.
So I think it's really good. So a couple misconceptions. Number one, FHA loan is not just for first-time home buyers. That's a really good one to get rid of. Veterans loans, it's not that you only can use it one time. It really is based on your eligibility. And again, it's individual to, who it is and what you've done in the past. So you should really talk to Brian and find this out. And then the one you talked about was the 203H for hurricane, a very special kind of one where you can actually have it's construction or repairs.
Yep, so the 203H is the FHA loan that if you were displaced from a property as a result of a disaster, which the entire state of Florida is a federally declared disaster area.
Right.
That allows you to buy a new property, 0% down, with none of the current liability, whether it's a mortgage or rent, being included in your qualifications. You qualify for that home all by itself, none of your current liabilities or none of your current obligations to the property that you were displaced from count against your debt to income ratio, which is what's used to qualify you.
So Brian, you are a very unusual mortgage lender in a variety of ways, and this is your house, so to speak. So will you talk a little bit about what makes you different?
Yeah. So, the name of my company is Custom Rate Mortgage. We're based out of St. Petersburg, where I'm born and raised. And over the years, I've been doing mortgages now for a little over 7 years. You learn things. Everybody does. Everybody out there listening or watching or whatever, anyone who's been in a job for any amount of time, they learn things about what their industry does or how it works. So, over time, I was very blessed and, became one of the top 1% loan officers in the state a few years in a row. And I was with the largest brokerage in the country, got up to the number 2 producer in that country nationwide. And, all of that is not meant to sound braggy. It's just experience, right? That is all that is meant to highlight. It's experience, and experience matters. As you mentioned, I think in the beginning of, our conversation, it's interesting how different loan officers sound. It's different what they know, what they don't know. That's one of the main points of feedback I hear from my clients when I speak to them for the first time after they've spoken to another loan officer. It's like, wow, they didn't know any of that. I didn't answer that question. It's just that's experience, and that matters a lot. So, but through that experience and through that time, you figure out how things work if you care to look. And I am one of those people who very much care to look. And I built a company in a different way, right? Compared to the traditionally structured mortgage. The traditional mortgage is set up in a way that there is a fixed margin built in already, baked in to the rate. You're paying for it. It is what it is. An individual loan officer, like if you called me or somebody else that that does mortgages, the vast majority or incredible likelihood of what they can do to change that is non-existent. They can't change the structure of a corporate policy at their discretion as an individual loan officer. They just can't, right? Because it's applied to that entire company as a whole. So what they'll do, it doesn't matter if it's your dad or your brother, you can't just say, you know what, I'm going to go ahead and the company's going to make less on this one. I'm going to hook you up and I'll approve the company making less on this transaction because you're my friend or you're my family or whatever. It just doesn't work that way. They'll let them go down sometimes down into where they make nothing. The loan officer, they make nothing. The company is going to get theirs, and it's built in. It's already there. Right. So I've created a company essentially where the margin is no longer fixed. It opens up the ability to be custom, no pun intended to the name of the company, Custom Rate. But it's essentially allows me and my loan officers, all my loan officers, right, to have full autonomy and authority over the rate stack. We call it the rates that we're looking at, the pricing of the rates we call it in the industry, right? They have full authority over that. There's no car salesman saying, you know what, let me talk to my manager and go see what I can do for you. If they could do it, they should have already done it, right? Why didn't they give you the best deal the first time? That's not right, you know? So what we can do here is something that's truly a special way to do a mortgage. There's no comparison. As an example, today, one of my loan officers got a loan. She's going to beat that lender by $15,000. It's a VA loan, almost $800,000 loan amount. She's going to save that borrower $15,000 in cost for the rate.
Yep.
And she's 1/4% lower on the rate on top of that, right? So we've done that by shopping it to the entire country, where I've selected only the best priced lenders, the lenders with the best rates that consumers don't have access to. Right? Only brokers can go to them. What's different is we're not going to them with a fixed margin that we have to adhere to. The margin is floating. We can control it individually as loan officers. So she went in, she priced it out because we have more options than the retail lender that you know with a brand you recognize that can only do what they can do. We have more options, go to the whole country, get a better rate and a better deal. So now this person, say 15 grand, 1/4% lower on the rate. It's like $150 less per month, all because she just checked with custom rate and with that loan officer custom rate to see what they could do. So it's truly a unique way to do a mortgage. And I believe in the future, this is how all mortgages will be done, because it's the most fair way for borrowers, for people buying a house, getting a mortgage, compared to the traditional structure that's just built for companies instead of people.
Yeah, definitely. So we're out of time. So I want to make sure that people know how to get a hold of you. If you'll share a website, social media, whatever you're willing to share.
Yeah, sure. So I usually, you know, it is that old school method. Feel free to call or text me. My number is 727-348-0486. I can be reached there directly anytime. And then my email is Brian, BRIAN, at mycustomrate.com.
Perfect. Well, Brian, thank you so much for sharing. As you know, I'm going to ask you to lift your voice and say yay with me as we go off the air. Is that okay?
You got it. Yes.
Very good. 3, 2, 1.
Yay.
Thank you.
If you could just help people understand the principles, then they could make better decisions in real estate. We started getting an audience. And so with the radio show, I actually get to help many, many people.
Hi, I'm Jack Canfield. You may know me as the co-author of the Chicken Sister of the Soul series. And if you want more help in getting from where you are to where you want to be, I want to encourage you to listen to the Jennifer Hammond Show